Good evening, everyone. Welcome to Apple Markets webinar. We're going to take a look at Fibonacci Advanced Part 2. Nanit and I will be tackling this topic together in this session of an hour. We look forward to it. We love Fibs, both of us, and use them dearly. So we are excited to share our thoughts and ideas about Fibs. First of all, though, two messages regarding warnings and risks. First of all, is that this webinar and the recording is shown to a global audience, but may not be suitable for everyone. Please take a look at admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity for more details and to see if it is suitable for you. Also, be aware regarding the risk that trading for exchange and global financial markets is considered higher risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. By continuing watching this webinar and recording, you agree with this disclaimer. Plus, you are also aware of the risk involved when trading. Goody good. Thank you so much for your attention on that. So, agenda today, the first part, of course, was a week ago, and we were talking about how to identify swings and looking at the Di Napoli method of using Fibonacci. Take a look, of course, at that webinar if you're interested in finding more information about that. Basically, you can find that webinar very easily by going to Admiral Markets YouTube channel, which I'm going to show you right now if technology is on my side. But in any case, you will be able to find the webinar, for instance, here. This is the link, so I'll send that to you. You can otherwise pause the video. If you're looking at the recording, if you're live here, you can take a look at it right there. And in general, you can find the Admiral Markets channel on YouTube by going to YouTube, click here for search Admiral Markets, and you'll find the channel and you'll be up to date about all the videos that are uploaded regularly. Today we're going to focus on other strategies. I like my target strategy and zigzag strategy. We're going to be briefly touching fibs and waves and fib ratios and targets, and basically using a defensive way of trading fibs as well. And a quick reference to fib sequences. Basically, that was a webinar that I did about half a year ago, and you can find that here. Sorry for all these videos, but that is something we'll not discuss today, but that was done already in the past, and that is something I definitely recommend taking a look at. Not using Fibonacci ratios, but actually the levels of Fibonacci for basically the levels, the numbers of Fibonacci, but using them in pips basically instead of the ratios. So you know that 34 is a Fibonacci sequence number. So I would use 55 as well for measuring pip movements instead of using it as a ratio or as a target. So that is explained in that webinar. So please look at that webinar for more information on that. We're not going to talk about that here, because that was a full hour only on that topic, so we're not going to make that. All right, so first strategy I wanted to talk about was basically trading zigzags, corrective zigzags, and how you can trade that two ways. First of all is counter trend with the momentum against the trend with the zigzag basically towards these targets. Secondly is waiting for the retracement, basically the zigzag to complete, and trading it at these targets, away from, with the trend, I should say. So if we take an example here, meanwhile, you might want to write down these numbers if you don't know them already. To give you an example, for instance, we had here a retracement fib with retracement levels like the 23, 38, 50, 61.8, 78.6 fib, and 88.6. Plus you have a zigzag, a counter trend momentum fib showing that price is retracing, not able to break this bottom here, and then going to targets. Unfortunately, I have to just check with you if you can hear me. Okay, probably yes, but probably it was just one person that had sound problems there. Great, I got confirmation. Yes, the webinar is recorded indeed. So when you see, for instance, the targets here, that is basically showing confluence with the retracements. Often enough, that is what happens. The retracement is in confluence with the target. And often enough, you can actually estimate how big this first correction will be because you know that the second leg or the third leg will equal roughly the first and will end up roughly at these retracement levels. All right, but that's a bit more advanced. Again, then you're trying to measure how far this move can go because you know that if there is an ABC zigzag, how far typically the price goes. Anyhow, let's put that aside. More importantly, though, all right, the most important is that there are a couple of ways of trading it. First of all is at these targets to the downside with the bigger trend as the zigzag completes. That is the with the trend setup, in fact. Although it's against the momentum, if you trade it early, if you trade it right at the target, then obviously the momentum is up at that point. The other method would be to trade it as a counter trend trade here, right there, for the move up, anticipating the bigger zigzag to the upside. For that to happen, however, you need divergence on a higher time frame like a 4-hour, or even double divergence on lower time frames. So, that is something that you must have, because otherwise, if there is a trend to the downside and you want to trade reversal, it wouldn't work out on average. It would be too risky, and you might be buying this dip, but price could make a retrace, but then fall like this. So you wouldn't get the zigzag. Many times corrections don't make zigzags like this, and price just consolidates, builds a triangle, and then breaks and continues. So you need that divergence. Preferably, there's also some confluence, some strong levels of support that could stop price from continuing lower and could create this extra fuel for this zigzag to the upside. So those are the two things, main things, how to trade corrective zigzags like this. And you could use 2 fibs for this purpose, retracement and a target. 2 fibs, basically, one with the trend, one the momentum against the trend. So where could the trend stop and where could the zigzag stop? Well, basically the zigzag typically goes deep to a 78.6 fib or a 61 or even an 88.6 fib if it is trading against a trend. Right? Zigzags can actually stop at any of these fibs. All right, it is possible, but if it's against the trend, you will typically see a bit deeper one. The zigzag most of the time ends up at this target, the minus 61.8. That is the most recurring spot that the trend continues if this is a corrective zigzag for a downtrend continuation. This is the main target. The exceptions are this one, which is shallower target. That is typically hit when you have a deeper fib, like a 78.6 fib or an 88.6 fib. Sometimes you go further, price can extend further to a higher target. That can happen specifically if the fib is shallow. The retracement fib is 23.6 or 38.2. On average, you will see the middle one being hit the most. But because it's not 100% guaranteed, like nothing else is in Forex, one of the best ways to actually trade it is by waiting for price action candlestick pattern or equivalent, some reaction to the target before trading it. Because otherwise there is always there is a bit of chance that price could just push through the target and go to the next target. This is pound dollar 4-hour chart indeed. Or an example of earlier this year, I believe. We'll take a look at live charts now, actually. Last week I was making more screenshots, but it was perhaps difficult for some of you to see the charts, properly. So I decided to more focus on live charts. All right, so let's take a look at live charts, in fact, right now. This week we had a couple of zigzag examples, in fact, on the euro dollar and pound dollar, and those were great things. This is, by the way, just quickly wanted to explain a correlation matrix, very useful to understand what the relationship is between all these currency pairs within the Forex market. It is part of a extra features that MetaTrader 4 Supreme Edition offers. It is something that Admiral Markets has developed, 60 extra things, and I highly recommend taking a look at it. If you open a demo, you can use this and test it for a month, or if you have a live account, you can use it fully. Now, regarding those zigzags, be aware that here we had the opportunity. All right, this was the first. What actually we had one fib here, right? This is the first fib we should put on. That is the main trend, which is down at the moment. We have basically a great fall at this point. That is the fib we want to have on. As long as this top doesn't get broken, as long as we don't have a clear, let's say, uptrend channel or so, where price is moving up again and then down and then like this, and then we might neglect this fib for the moment. This is the dominant swing high, swing low for this currency pair, and it has been ever since this moment, right here. That's the first fib we want on. Then we might expect a impulsive zigzag like this to occur as a correction. Now, what I did at first was put a fib from here to here. All right, and you can see, let me get rid of this one so we're not mixing it up too much, and let me make this a different color quickly. Let's make this light orange, all right, or gold. You see the price stopped at that 78.6 fib. Now, I would not advocate to buy at this fib, even though it respected it, and in retrospect, we can see that price nicely bounced off that level. I would not recommend to trade at that level because we do not have clear divergence between any bottoms. We have just a gigantic fall of 500 or more pips. There's no reason to look for, in my opinion, reversal trades due to the lack of divergence and the strong momentum to the downside. Did it work out? Yes. But point of trading is following good rules and being consistent in that. And just because by coincidence once it works out doesn't mean that in the long term that would be a good idea. All right, but I just want to show that these fibs can be respected sometimes even if we don't expect it. All right, so but not a good trade though, in my opinion. We don't have divergence, and there's too much of a downtrend and down momentum with a long-term breakout as well, etc. What is true though is the opposite, is that if price would have gotten to these targets, those would have been interesting levels to look for shorts as a downtrend continuation. In that case, we get a ABC bullish zigzag, and when price gets to those targets, that could be interesting for reversals. Even in this case, the minus 272 target, because we had a deep fib. Normally, the confluence between the retracement and the targets is a bit better. Here, we don't have much confluence. We do have confluence between this fib and this retracement. Well, it seemed that price was not going to get there. Yesterday, I actually decided to move the fib to here and here. And the reason is because I expected a smaller ABC correction like this. So I decided to use a smaller swing high, swing low. And I was saying yesterday that I'm expecting a intraday bullish momentum because we are in a triangle here. And price broke that triangle to the upside. And once it broke the triangle to the upside here, I said today, that was yesterday, I would expect an intraday bullish push to the targets, after which I expect price to revert back down again and a bounce lower. And you can look this up. You can go back, look at the webinars, and you'll see this is not post-fact. This was all said pre-fact, right? Just to make sure everyone is on board with that. So, and the reason is because this had momentum. I expected a bigger correction under your dollar before we have a continuation of the downtrend. We had a respect of the 50 fib and a break of this triangle. And we did. We had an intraday upside, choppy one, yes. And I said, don't make it a swing trade to the upside. Don't look for a long-term trade to the upside because these targets are going to be heavy resistance. We have confluence at the 111.50 plus 50 fib, all right, and minus 1,000 and 61.8 fib all of these fib targets will be spots where price can revert back into the downtrend. So this was actually a trade that was taken to the upside, all right, based on zigzag concept, but at a different spot, because I didn't want to take, there was no divergence, so I didn't take this. But I did take this because it was a different situation. It was maybe less of a zigzag trade than a breakout trade, but still, the fibs helped me understand the structure of the market. The zigzag concept was very much part of the analysis why I took it to the upside, and the target, of course, providing guidance where I could exit the trade. Now you see at this point that price has respected that target and has made a downside. Anyone who was looking for a reversal trade, or I should say with the trend trade here, actually, right? Because this is the down, the trend is still down on higher time frames, would have done an excellent job if taking 111.50, because price has gone already 130 pips to the downside. All right. So, pound, example of zigzags. Another basically similar situation here. Also said that price is put the fib on from here to here. That had to do with waves, expecting 1, 2, 3, 4, 5. So what you want to do with fibs is put the fibs on the waves that make sense. If a wave 1 has been completed, you want to put the fib on wave 1. If wave 3 has been completed, you want to do that on 3. If a 5 wave has been completed, again, you want to put it on all 5 waves. If there's a deep wave 2 correction, then you can put it on wave 1, but also on the first part of the correction. As I actually am now explaining, this strategy, the zigzag strategy, is very much also connected to waves. You don't need to know the waves to use the strategy, but if you do know the waves, then you know why I'm talking about placing a fib on the very first part of an impulse, because that is an A, B, C correction, and you know very well why that idea is there. Wave 3 is the largest, and as you can see, wave 1 here, wave 2, and the 3 is by far the largest here, as you can see. Yeah. So that indeed meets the idea of a wave 3, and you're absolutely right. Wave 3 is not by any means can be the smallest. Normally, it is the largest indeed. Alrighty. Can I change the color to red or green? It will show up better on the screen. Green, yeah, sure. Green, yeah, there we go. So here we had, so I put a fib from here to here. As a zigzag, we got a 50% bounce, we got a break, just like the euro dollar, and a push up to 135. I said in the webinar as well, 135 will be a big turning spot, or 137. And indeed, look at that, 135 respected. Intraday upside, I said, just like the euro dollar, basically same story. I don't want to repeat myself. So break, intraday upside, indeed, as expected, that happened. Stopped at 135 as expected. And we got a big turnaround so far, down at 132, 300 pips away from the turning spot so far. And while looking at this particular candle breakout, you can see that this is a potential, I think, looking like a good breakout for further downside to 130 perhaps. Pound odd as well, you can see here, I took a zigzag trade to the upside off of this 50 fib bounce, and we had a bullish candle. That was the candlestick confirmation of a bounce at the 50 fib, and I took it a bit later. I just saw it like an hour later, but I saw that the price was not too far from this pattern, and I took here about 150 pips, and that was indeed the turning spot that happened. So that was another zigzag example. But specifically I wanted to show you is how you can use candlestick patterns to identify the responses to fib retracement levels. Head and shoulders, yeah, indeed, there was a bit of a this like that here. and price broke the neckline, made a dash to the target, and then started to go back down again. This breakout basically, depending on what time frame you're looking at, but a good thing could be, for instance, like this, an hourly. So if you have engulfing twins like this, that could be it. Or if you see the next breakout candle, that could be it. An entry right there with a stop loss below. Sorry, the entry is here and the stop loss here. Those could have been two entries, in fact, depending on how you look at it. 50-minute chart would have been another way to do it. Here, actually, with regard to yesterday, in the live session, I said the ACU Murimath system that Nennet and I are trading, and that Nennet has shown such a great results with, would have been an entry right here, in fact. So that entry grabbed easily 60 pips on this first move up. If you're not using ACU, then maybe you could have taken it on this dip here. You see a good breakout candle on the 15, and you see a dip, a break, retracement, continuation. Those could have been potentials there. So that's enough on the zigzags for the moment. I think I'm running out of time, so let's move on to the next strategy I wanted to show you, and that's basically trading to targets. So let me go back to the live charts. Alrighty, let's put on a blank dashboard. Target trading is basically waiting for price to get to the minus 61.8 target. In most cases, the exception is the 78.6 fib plus the 88.6 fib. If those are the fibs used, then we actually wait for the minus 272 target. That's why I was showing those targets at the beginning. They're very important. The idea is that we do not move the fib before we hit these targets. The idea is that we only use one fib on one time frame, and we wait for the target to be hit before we move that fib. So let's go back in the past, because I don't have any example of this week, like the zigzags, so we'll have to use historical data for that. But you want to identify, first of all, the moment where the trend changes. So that's a different topic. I can't dive into that now. But you could use, for instance, the first time a target gets hit to move the fib. So let's use orange here. There we go. So if you, for instance, put a fib from here to here, I'm not sure if this is an uptrend though. So let me use a very simple moving averages so that we have at least a visual grasp of that. That's not what I'm looking for, excuse me. That is. Yeah. Excuse me, just had to sneeze there. I will be there very soon. That's it, good. We are looking for, let's go to the hourly. All right, let's grab this uptrend here. All right. So what we want to do is, when price is showing an uptrend here, for instance, this is still could be considered a counter trend move. What you want to do is fib the first swing high, swing low. So what you want to do is grab the bottom and draw the fib to the very first resistance spot, the first turning spot. Then you want to see where price has hit the target, and then you want to move the fib from retracement to the target. So in this case, our fib, next fib, would be from the bottom, the new bottom, from the retracement bounce basically, to where price stopped when it hit a target, which is here. All right. Some could do here. That's fine too. I mean, it's not that important. Which swing high, swing low you use. In this case, if you use fractals, for instance, to identify pausing spots, then you would use this top. If you're using bigger kind of swing high, swing lows, then you would probably draw it to this top. In any case, regardless, both fibs got respected by a very deep fib, as you can see. And the target, this is the new fib. Once the bottom breaks, that fib is invalidated. As long as this bottom does not break in an uptrend, it remains valid. And we're looking for price to hit the next target before moving the swing high, swing low. All right, so that's the minus 61.8, which we do here. So we can move the fib again from the new bottom, which is here, to the new top. So from this moment onwards, basically, or from this moment onwards, since, if you look at the moving averages for a trend, we will be using this fib. The very first one we would not be really using. That's in retrospect. We wouldn't use that because it's a counter trend zigzag. If we were looking for zigzags, we might use it, but not for this strategy because it's a counter trend. Only when we have the trend, and the trend is aligned from here. So if we were looking for fib bounces, we could have taken some entries here and would have taken our exit somewhere here at these targets. So once we hit the target, then this fib is not relevant anymore. We had one successful trade, and we would move the fib to the new swing high, swing low once the price hits the target and not anytime sooner. So this is the new swing high, swing low. Right, so we're looking for, again, a fib bounce for continuation. Once again, this is the validation level. That's where the stop loss also should be, below this bottom. Price, it's a 78.6 fib. Again, a deep fib, which means that we're waiting for a minus 272 target. That is enough to move the fib, which we will do then to here. That is the new swing high, swing low, from this bottom to where price hit the target. And we're looking for a continuation back up. Now you see 50 fib bounce, and eventually we see a failure to break the top. So if you see failures to break the top, if you see that it's taking too long, for whatever reason, you don't feel embarrassed or ashamed or hesitant to move the stop loss to below this bottom, to reduce risk or to break even. Especially if you see momentum like this in the opposite direction, then you want to be worried that you can get a bigger counter trend zigzag, and then the fib might fail. So we had two good fibs. We had two situations where the fib worked well. This third one, it didn't, and it failed. So if everything went okay from a trade management perspective, it could have been a break-even trade. If not, then this was a loss. So it's either 2 wins and a loss, or 2 wins and a break-even when fibbing this method. I think there was good signals to be cautious of getting out, but that's of course easier said in retrospect. So once this bottom breaks, then we're not looking for upside fibs on this time frame. You can use fibs like this on multiple time frames. You would have a fib for each time frame. However, that could become a bit more confusing because then you're looking at different fibs at different time frames, maybe at different directions. So that could be a bit more difficult, and you want to build your experience gradually. I would recommend using this in combination with other concepts like trend, patterns, not as a standalone strategy. Once the bottom breaks, we can put the fib on the opposite direction, and we will see that here, for instance, the target gets hit. So we can move the fib. So we're moving the fib until we find a swing high, swing low, where the target has not been hit yet. So we see, basically, look at this situation. Price hits the 23.6 fib, goes to the target. That's where our invalidation level broke from the upside. So once that happens, right here, we have the green arrow, where we have this bearish fib on. We immediately move, basically, as long as we have a trend and keep a trend, we move from the bullish fib to the bearish fib. Now, if there's no trend, we don't put any fib. We see price hit the target, right? But not the main target, a small target. So we're looking for retracement. If price gets up to these fibs, we'll still be interested in trading it to the target. And look, it hits the 61.8, makes a turn, and hits the main target. Alrighty. Last but not least, I talked a bit about it already. Fib sequences, right? As I said, this is a separate webinar. I would like to, show I would like to warn you of it, that that 1 hour video only on Fib sequences is available. I would appreciate it if you take a look. I really find it a fascinating topic. Really enjoy it a lot. And so if you take the time to look at it, I would be glad. And I think that it could be useful for you. Perhaps not, but I think it's worth the time. Regarding ratios targets, we talked about it already. Regarding fibs and waves, basically, once more, I wanted to just explain that you want to use fibs on waves 1, on waves 3, or on waves 1, 2, 3, 4, 5, on the entire upside, on the entire 5 wave, on a wave 1 or a wave 3. What you don't want to do is put it on a wave 5. So what you don't want to do is, if you have a 5 wave up, you don't want to put the fib on this 5 wave like this, because there is a chance of an ABC zigzag, and then you get stopped out. That you don't want to do. Of course, there could be extended 5 waves. That's why you still might want to zoom in, but be careful of the trend stopping, and be careful of the fact that it could be an ABC correction. What I meant with this last slide, basically, very quickly, is that if you are fibbing, for instance, let me show you an example. If you have a fib here, like on this 4-hour chart, all right, let's put a fib from here to here. You see a 61.8 bounce. So, one of the strategies that, or not a strategy, but one of the targets that is good is if you take this 61.8 fib by zooming into lower time frames and you see a reaction of price at this fib level, and you take it. If you want to look for a very secure target, what you could do is, instead of leaving this fib on and aiming for the minus 272, minus 61.8, sometimes it takes a while before price gets there. Well, not in this case, but sometimes it does, because trends can be slow sometimes. So if you want to get out quickly, what you can do is put a fib from here to here, and then exit on the 61.8 fib opposite fib. Just in case there is a zigzag, you get out at a sweet spot, because even if there is a bigger retracement, you get out with profit. So you grab, in this case, less profit, but you get out quicker. Plus, there's a higher chance that you grab the profit. So if you're looking for a quicker way to exit a fib bounce, you can draw the fib on the opposite direction and look to get out at the 61.8. I would love to talk more about fibs. I got, from a fib point of view, I guess I have a feeling I could keep on talking forever almost. But Nenad has also awesome stuff to present, and I've been way past my time. So I'm going to pass it over to Nenad now. And we're going to take a look at what Nenad has to talk about fibs. Let me see if I can find Nenad here in this list. Nenad, are you there?
Yeah, thanks, Chris. I'm here. I will just switch the screen in a second. And here we are, guys. So, yeah, fibs. I will show you some new tricks regarding fibs. As Chris already told you some interesting stuff about Fibonacci. He's really deep into that. And my own research, well, you know that I really like MACD, so I did some research on higher time frames for MACD and Fibonacci, and this little trick, I guess there are two tricks that I will be showing you. You can use as an example of a trading system, or you can even incorporate this into your own trading system. Okay? So let's see, guys. First of all, you need to know how to recognize the trend. And I'm sure that you already know that trend is a series of higher highs and higher lows, that is uptrend, and downtrend is a series of lower highs and lower lows. Now, yeah, Mask Rider is saying that normal MT4 does not have it. Yes, this is two-line MACD, and you can always ask me about this. I will send you. This is what I use and what Chris also have been using. And you just need to send it to my email. It's tarantulafx@gmail.com. So if you send a request, I will send it over. So the point is that you need MACD 2-line. I call it Camarilla MACD. And first of all, you need to identify a trend. So this works on higher time frames, guys, okay? So first you need to identify a time frame, a trend on a higher time frame. And you trade 4-hour or daily chart, okay? So I will focus on daily chart. And this is suitable for part-time traders and traders who don't have the time to stare at screen, and it's very good method, guys. It's very simple, and I'm sure that you will like it. So you need to identify a trend, okay? So first, let's use a couple of examples. Here we have an uptrend. You see there is a series of higher highs and higher lows, okay, like this. You know how to identify, but the problem usually arises when traders are not able to identify a start of downtrend. But it's easily identified. You really don't need any special indicator to tell you that it's a trend change. You actually need to connect most important lows, like this here, this one, this one, this one. You will see here, guys, it does not need to be that perfect, you know, because you are not Picasso. You are actually traders, right? So the trend lines are just a visual representation of price. So when you see this, okay, you see that there is 1, 2, 3, 4, 5, 6 touches. Here there was a break, and then here we see actually a pullback. So this is the start of a new trend, okay? It's always about the trend lines. It's always about trend change and possible retracements, because trend will not last forever. Indeed, Nathan, this is so-called inner trend line. I spoken about inner trend line a lot of times in the past, and I'm still speaking about it because that is price action in its core, right? That is the core price action. So inner trend line. Why inner trend line? For all of you who are new and for all of people who will be listening to us over YouTube, well, inner trend line is simply a trend line that has been broken. So here, this was a normal trend line. This was just a normal trend line until this spot on. So after this spot has been broken, well, we can assume that this trend line, normal trend line, became an inner trend line. And here we have a trend change. So basically, guys, when you see this, you need to know where to enter the market. It's very easily defined. Just go with previous swing high and low. You already know how we can use Fibonacci. We always use it from left to right, from past to present. If you ask why, well, the answer is because past and present will give you the future outcome. It's how things work in our universe. It's how things work on planet Earth. It's how things work in our business. Okay? So it's always past and present will give you the future outcome. 1 + 1 = 2. 1 + 2 = 3. 2 + 3 = 5. 3 + 5 = 8. And so on. Fibonacci sequence. So here we are. Insert Fibonacci retracement. And we go from, let's say, this was the bottom. Well, you can also use this one because, guys, obviously this is also an important swing and this respects it. So we will use this swing low, this swing high to project a possible retracement. Now I'm still talking. I need to put it like this because this was uptrend. Okay, so this was uptrend. Swing high, swing low, swing high, and then I will move it to downtrend example. So here we didn't know what will happen, right? So let's use it like this. Okay, swing low, swing high. So what happened? You see? Now you see, guys. Actually, the price has bounced back from 50. Okay, it bounced back from 50. That was in confluence with our trend line. Okay, but well, then you see the price simply start to drop. Well, here you can see it was a 100 pip jump, right? That was not bad. But if we use MACD as I will be showing you, there was no any signal. So you actually need to go with this example. Now this is swing high, this is swing low, because this is now downtrend. We need to know where we will actually enter the market, and I will show you now. So from the top to the bottom, watch this now. From the top to the bottom, from left to right, and we need a cross and rejection. This is it, guys. Let me zoom in. Here you see a rejection of 50 fib, but you don't see a MACD cross. Here everything is aligned, but where did it happen? Actually, this was your entry. Add this break. So this was your entry, guys. Okay, so this was your entry. Your first entry was here, and then as the price went up, retracing further, your next entry could have been here. Again, your next entry could have been here. So guys, this is just trend following. In order for you to trade Fibonacci this way, you need to see at least 61.8, okay, 61.8 up to 78 and 88.6 retracement, and you need to see MACD above zero line, and these two lines need to cross. So this is your signal. Additionally, you can try to actually trade also from 50, but the problem is very often you will see that the price after a strong trend, it will make a bigger pullback. So only you can use 50 or 38.2 if you see that there wasn't a very, very strong movement. Okay, so in this example, guys, you just need to measure it. In this example, you see the movement was 344 pips, right? Roughly. Here in this example, the movement was like 230. So basically, when you see that the movement is not that big, there is no specific number because every pair has its own range, but you can always watch the history to find out the proper setting. Here, basically, you can see that we have a good rejection from this level. Now, you need to readjust the fib, always, guys. So once you see this, you need to readjust the fib. In this example, okay, in this example, where is our trend line? Inner trend line. Our inner trend line is actually here, okay? So this is inner trend line. So from the top to the bottom, so previous swing high, you don't need to go that high. Previous swing high is this. So let's measure it. Previous swing high to swing low, only 167 pips. So it's not that big, right? So we can use 38.2 rejections. Do a fib like this. Oh, well, this is actually 78.6. It's even better, right? Because it's a deeper retracement. And here, this is your signal to actually go short. Okay, here. It's a little bit, as I say, it's a little bit, the price has already gone. Okay, you see it's already gone. But there is a remedy to that. This was a good trade because if you traded this, you would put your stop loss here and go for at least 1-to-1 risk to reward. But there is a trick, guys. The trick is my favorite candlestick pattern. That is called a pin bar. So when you see a pin bar rejection like this from, let's say, trend line and 78.6 confluence, or straight from 61 or 70 or 88.6 fib like this, this will be your signal. When you see a pin bar close, you immediately enter the market. Now, if you see that MACD is actually switching colors, that like this from blue to red, that means that you can ride the trend. Okay, that means that you are still in the trend. So you see rejection here, pin bar closed, you enter the market here. Now at this time the market turned red and you are still in a trade. So you are riding a trend, you're riding a free trend, and actually you just need to watch for weekly pivot points or historical support resistance and take your profit there. But at least 1-to-1 reward to ratio, risk to reward ratio. So you see, it's very easy. Here we have, I have prepared another example here, a downtrend, okay? So when you see the price is in downtrend, so this was uptrend, mini uptrend, okay? Here, this was indeed a mini uptrend like this, and the price has made a move like this. So this was indeed a swing low, swing high. So this is high, this is low, this is swing high. So we don't know what will happen. We just see that this is swing high, okay? And next candle is retracement. So we actually want to fib this one, okay? We actually want to fib this one. So from the top to the bottom, okay? Again, it's 78.6, guys, you see? But we don't have a pin bar, so we don't enter after the close of pin bar. We are actually waiting for MACD to cross. And here it goes. Well, here we see a pin bar, so this could be a good rejection. But also next candle gave us a good cross here, okay? So this was it, a cross. And here, this was your signal. And you see, and this was just to ride the MAC. So when you see this and you're still in a trade, well, ride the trend, guys. Ride the trend, because this could be a good ride, and you can see it here. Okay, so another example. Okay, the price falling down, you're already in profit, you made your profits. Now the price made a huge swing. Swing high, swing low. Okay, momentum candle here. So swing high, swing low. Watch this, 88.6, guys, to this is almost a pin bar. But here you see a clear pin bar here, here. So you actually, this was a clear signal for you to go short. Also, MACD turned bearish here. So this was your actually, no, this one was bearish MACD. So this is a continuation. So once you are in a trade by rejection of these pin bars, you need to use continuation signal, that is MACD. So guys, this is this example and this mini system. I know you can always use it for actually finding good trades. This will be the part of my swing system that I already announced. The swing system will be available to all Admiral Market traders and users, and I will be presenting it possibly in September, I think, because it's still in testing phase. Currently it's beta phase, but this is beta 1 because I need to make a beta 2 phase, and then I need to demo trade it to see how it behaves. So guys, you will be the first to know. This will be a part of, Bollinger Band. You already asked for it, but I told you that it will be done in the future. So be patient, guys. So at this point, it's enough for you to know that this is how you could actually benefit from this. This could be a system for itself because it uses strong foundation of price action. But also one of the biggest strengths is you use pin bars that indicates now moment sellers, okay, and you use Fibonacci that is always omnipotent. And here you can see MACD can be used either for signal or for continuation, guys. If you are early in the trade by taking a pin bar rejection, then if you see a red MACD going down, then you need to ride the trend and leave your trade running. Thanks, Ron. Yeah, indeed, this is very interesting. And because a lot of traders were asking me for a swing system, for a system that they could actually trade during the weekend, and this is it, this could be it, and this will be the part of my swing system. Another possible interesting stuff, guys, is actually using alligator, Bill Williams alligator with Fibonacci and stochastic 1433. Another good idea is to actually use confirmation from alligator to enter the market. So whenever you see this, guys, okay, you know that this is actually when alligator is sleeping. So no trades are taken. When alligator gaps his mouth like this, his jaws are open, we need to know that there is actually a possible trend in development. When blue is above red, red above green, we know that that is actually a downtrend. So here we saw a swing high, here there was a swing low. Then we see a rejection. Confirmation for your entry is stochastic. Stochastic needs to be above 80. When you see a cross of 80 stochastic, that is your entry. You're riding with a trend, okay, until you see that actually price is making a bigger pullback like this. When you see that actually there was a change of alligator jaws like this, you close your trade. These EMAs are alligator EMAs. So when you go to indicators list, alligator, it's those EMAs are shifted in the future. So those are 13, 8, and 5, shift 8, 5, 3. Medium price, high, low, 2, smoothed. So this is alligator, okay? And you can find it on MT4. And you see here, and actually this could be a good spot for you to take profits here. For this, you need to spot a good trend, because if the price is not in a good trend, then it's usually futile. Here you see another possible short, because guys, you will always see signals when actually most of the time when price is ranging like this, because here you see that the price is actually in a range, and then and jaws are actually closed, and here you see there was a signal and jaws opened, and you're actually riding a trend until here. Here there could be a possible sell signal, and there is a sell signal here on Euro Yen. And guys, as I say, always watch for possible good trends like this. This is not so good trend, but actually this could be very interesting to watch. So jaws are open. There is a retracement from here to here. You see, and possible rejection here, guys, exactly 61.8, where bang, the price went up. So follow these EMAs, and actually you might get into a nice profit. So also this is important, guys. You need to watch for stochastic. You cannot do this without stochastic. So here we have uptrend, here uptrend. So insert Fibonacci retracement from swing low to swing high, and you see, guys, because these alligators MAs are actually they look forward into the future. You will possibly see that they might intertwine, but here the signal was still valid like this. You see, they intertwined actually, and here there was a rejection from 88.6. Even if you use this swing low, that could be 78.6, and you see stochastic. So still they were up like this, and the price went up. As I say, they're very, very, very useful when trend is strong, like here, but you see there is only one signal. Again, when you see a strong trend, these jaws would be open almost all the time. You see, so if you saw a strong trend, you need to know that jaws would be open like this. 50 rejection and lock stochastic. When you see stochastic above 80 and you see a cross above 80, you can also take this signal. So it doesn't need to cross below 80. It can be above 80, but blue and red needs to cross like this. You see this, and the price is going down. And if you follow the where actually where jaws closed, and when this red EMA crossed with green, this could be your profit. So this could be, as I say, very interesting, guys. But in order to trade this, here another entry, you need to actually be able to spot these Fibo retracements properly. So here we could use this swing. So insert Fibonacci retracement. You can use this one, this one, this one, but I would probably go with previous swing low. So this is swing low. Here and here 50 rejection. Here you see they're going up, and yeah, see, at least there was a trend change, but this could be good, like 158 pips. So guys, watch for this, use these combinations. This could be a part of something very, very interesting that you could be able to use on higher time frames. You don't use this on lower time frames, because this is intended for higher time frames. See here, guys, price here, jaws open, price retracing. This is a start of retracement. This first bearish candle, draw a fib, rejection from 50, Watch this, stochastic cross, your entry here, bang, you're in profit. Interesting, right? So take a look at this. Guys, if you need any questions answered, please send your questions, comment under the video. This video will be uploaded. So we are eager to help you. And as I say, this is intended for part-time traders and traders who actually don't have the time to watch for intraday charts, so they can really benefit from this. Guys, thank you for listening to me. And Chris, we will be always coming with good ideas. These are one of the ideas. Who knows, maybe this will be your favorite idea. Maybe this will be your favorite system, or incorporate it into your future next favorite system. But anyway, this is core price action, and you should know about it. It's actually very useful. Thank you for listening. I don't see any questions. We will be here with you soon. And don't forget that we are here to help you. Okay, guys? Cheers, and as always, trade safe.